Okay, listener, buckle up. You've given us a truly fascinating stack of source material, the Q1 2025 earnings reports and webcasts from some really big global companies, all sorts of industries here.
Yeah, quite a mix.
So we're going to take a deep dive into just these sources today. Think of this as like your personal shortcut to understanding what's really happening out there, straight from the people running these huge operations.
That's right. These reports, they give you this unique real-time snapshot. It's about the pressures, the opportunities, the strategies they're actually dealing with right now in Q1 2025. It's not guesswork, it's their reality.
Right. And our mission is basically to cut through the jargon, the numbers, and pull out five big themes, five interconnected themes that just jump out from what these companies told investors.
Exactly what they said.
What immediately strikes me, just looking across all these different reports, is how companies in totally different sectors, they're seeing and reacting to really similar underlying forces. It's like this global ripple effect.
It really is. Everyone's navigating it. Ready to jump in?
Absolutely. Let's start with, well, probably the loudest signal coming through. It's just this intense focus on and investment in artificial intelligence.
Ah, yes. We're calling this theme one, the AI infrastructure, arms race, and capacity constraints.
Yeah, arms race feels about right. It's not just CEOs saying AI is important anymore, is it? This is about concrete action, massive spending.
Totally. They're essentially building let's call them the physical and digital factories needed for AI. But they're hitting a snag, a big one.
Which is?
They just can't build capacity fast enough. Demand is huge.
Right. They can't keep up.
Exactly.
Yeah.
It's a fundamental shift. AI isn't just, software you download. It needs immense computing power, these huge data centers, specialized hardware. And these reports, they confirm adoption is still really early stage, but the build-out, that foundation, is happening now.
Yeah.
And it's fast, unprecedented, really.
You see it right there in the growth numbers. Alibaba Cloud, their revenue growth actually accelerated to 18% in Q1, and they specifically called out AI-related products having, get this, triple-digit year-over-year growth.
Triple-digit. Wow.
For the seventh quarter in a row. So customer demand is strong. They're pouring money into AI infrastructure, even with, supply chain uncertainties hanging around.
And it's not just one region either. Look at Amazon AWS. They said their AI business is already a multi-billion-dollar annual run rate.
Yeah.
And guess what?
Let me guess. Triple-digit growth.
You got it. Triple-digit year-over-year growth. And they made it really clear. They're deploying capacity, the latest NVIDIA chips, their own Trainium 2 chips as fast as humanly possible, and it's just being snapped up. Instantly.
Snapped up instantly. That says it all, really.
They did mention some bottlenecks, specific components like motherboards, but they think that'll ease up.
Okay. And Meta, they chimed in too, right? Saying demand for compute is exceeding their capacity.
Exactly. Even with new data centers coming online this year. That imbalance is just fueling huge infrastructure investment for them.
Then you've got Oracle reporting, what was it? Hyper growth?
Yeah, hyper growth in AI training, and there's cloud database stuff linked to AI. And they were going big, building a massive liquid-cooled NVIDIA cluster, 64,000 GPUs, plus a multi-billion-dollar deal with AMD for 30,000 of their new AI chips.
Wow. And they're helping customers use these models on their own data, too, with some new platform.
Right. And from the chip maker side, NVIDIA, they talked about reasoning AI, the AI that processes and decides things, driving exponential demand growth for inference. They literally see AI as infrastructure needing factories.
Factories for AI. I like that.
They see adoption spreading enterprise, telcos, but they're working like crazy to balance this surge in demand with the supply of critical bits, especially that CoWoS packaging. That's complex stuff.
Yeah, that high-tech chip stacking. And they're looking out to 2026 for that balance.
Seems like it. And it ripples through the whole tech stack. Samsung sees solid AI server demand, expects it to stay strong with new GPUs coming. They're even developing special high-performance SSDs, storage, just for these AI servers.
Even Salesforce talking about their Agentforce AI platform and SAP building their business data cloud for reliable AI. It all points back to this core infrastructure demand driving strategy.
And Tencent had an interesting angle. Yeah, they're training large models, but they're also using AI right now for quick wins, better ad targeting, recommendations, and managing inference needs not just by buying GPUs, but through software tweaks, custom models, probably because of supply issues, maybe cost too.
So, okay, stepping back, what does this mean for you, the listener? This huge investment, these supply constraints, it's going to affect everything, right?
Absolutely. How fast new features show up in your apps, the cost of cloud services for businesses you use every day. It's a massive tech shift happening right in front of us.
Okay. So, one part of the economy is absolutely red hot with AI spending, but another major theme from these reports paints a very different picture on the demand side, particularly for individuals.
Ah, yes. Let's move to theme 2, the cautious and divided consumer.
Cautious and divided, that captures it.
Yeah, despite some good economic signs maybe, the clear message is a lot of consumers globally are hesitant. They're feeling under pressure. Companies are pointing to ongoing macro uncertainty, the cumulative hit from inflation, geopolitical stuff. It's all shaping how people spend or don't spend.
McDonald's gives some really striking numbers on this, didn't they? Especially in the US. Global comparable sales actually down 1% in Q1.
Down 1%, yeah. And they said traffic, actual customers coming in, was down more than expected in big markets, including the U.S.
And the breakdown of that traffic decline was the really telling part.
Exactly. Low-income consumer traffic down significantly, nearly double digits. Middle-income traffic down almost as much. It paints this picture, their words, of a truly divided U.S. economy.
Divided, yeah. Where lower and middle income folks are feeling the pinch from inflation, anxiety, while higher income traffic is holding up okay.
Such a stark difference within one market. And Nestlé, looking globally, kind of echoed this. Described consumers as not optimistic, cautious, concerned about the economy, policy uncertainty, especially noting more caution in saving in places like China.
And PPG, the paints company, they saw a slowdown too.
Yeah, consumer buying in the U.S. slowed after some retail restocking. Notice changes in Europe, too. They said U.S. consumer confidence metrics look weak, people doing smaller home projects, but bigger finance ones feel pressured.
So, okay, consumers are cautious. How are companies reacting? What are they doing about it?
Well, McDonald's is doubling down on value, launching everyday affordable price menus, entry-level bundles internationally, pushing their McValue platform in the U.S. Makes sense, right?
Yeah, meeting people where they are financially.
And Nestlé, their strategy is all about raising our game on cost savings, productivity. Why? So they can afford to invest in their brands, fix underperformers, launch new things, even in this tough environment. They're banking on the resilience of food and beverages.
This theme really hits home, I think. That pressure you might be feeling in your own budget from inflation or just uncertainty. These huge companies are seeing it in their sales figures, and they are actively designing products, pricing, everything around your cautious wallet.
Your sentiment is directly impacting their bottom line and their strategy. And that cautious consumer behavior, mixed with the wider global instability, it leads us right into our third big theme. This one's clearly hitting supply chains and costs hard.
Right. Let's talk about theme 3, geopolitical friction and supply chain resilience.
Yeah, this really shows that all the talk about tariffs, export controls, shifting trade policies, it's not just political chatter. It has real bottom-line financial impacts.
Tangible impacts. And it's forcing companies to make concrete changes, invest serious money in adapting their supply chains.
Absolutely. They're putting numbers on it now. J&J, for example, estimated a $400 million hit from tariffs, just in Q1, mostly medtech tariffs, especially China tariffs on U.S. goods.
400 million. Wow. And can they just raise prices to cover that?
Not easily. They said price increases are very limited. Contracts, regulations, especially in healthcare, make it tough. So they're focused on supply chain tweaks, cost cutting.
And ABBV, the other big pharma company, they're watching this too.
Oh, yeah. Monitoring speculation about new tariffs. Yep. They think any direct hit would be kind of in line with peers because they make a lot in the U.S. already. They're actually planning to invest over $10 billion domestically in the next decade.
So investing locally partly as a hedge.
Seems like part of it. Plus building inventory, finding alternate suppliers, cutting costs. Again, because price pass-through is hard for them too.
Abbott Labs also put a number on it, right? A few $100 million for the year.
Yeah, starting Q3, mostly U.S.-China impact. They're doing short-term things, like inventory adjustments, but the long-term plan is optimizing their whole global manufacturing network. That means significant capital investment.
And they made a point about tariffs being sticky, didn't they?
They did. A key lesson learned, they said. Once tariffs are on, they tend to stay. So you need sustainable, long-term fixes, not just wishful thinking.
It's not just healthcare feeling this. PPG, paints and coatings, they're getting hit too.
Yep, U.S. tariffs on stuff from China, raw materials, packaging, finished goods, plus retaliatory tariffs from Canada on their U.S. exports. So they're scrambling for sourcing flexibility, productivity gains, and maybe some targeted price increases where they absolutely have to.
What about Amazon? They must be navigating a complex web here.
For sure. They find it hard to predict outcomes, so they're sticking to their core. Broad selection, low prices, fast delivery, help the customer navigate. They did note their millions of sellers might react differently to tariffs.
And crucially, they mentioned diversifying their own production.
Yes, over the last 6 years, actively moving component production for AWS and their devices away from such a high concentration in China. That's proactive risk management right there.
Samsung saw effects, too. Some preemptive buying.
Yeah, after a pause on some tariffs. But they have to keep watching policy changes. It adds to demand volatility. And they directly linked a drop in their HBM sales, those critical AI memory chips, quarter over quarter, to export control impacts on AI chips.
That's a direct hit on the AI boom from geopolitics.
Exactly. And NVIDIA, the AI leader, same story. They're forecasting meaningfully down data center revenue from China next quarter. They even wrote down $4.5 billion in inventory and purchase commitments for their China-specific chip.
$4.5 billion, because they expect not to fulfill those orders.
Right, citing a potentially huge lost market opportunity in China, maybe near $50 billion, because they don't have the right product for that market under current rules. Even Salesforce, a software company, lists trade policy uncertainty, tariffs, retaliation as a key risk.
So for you listening, these geopolitical games, they aren't abstract. They can hit the cost, the availability of stuff you buy, electronics, consumer goods, even medicines. Companies are spending big to build more flexible, spread out supply networks to try and keep things moving.
That need to adapt, it also means many big established companies are fundamentally changing what they sell and how they plan to grow. Which brings us neatly to our fourth theme.
Okay, let's hear it.
Theme 4, reinventing for growth, shifting portfolios in established industries.
So this is about companies facing maybe declines in their older legacy businesses.
Exactly. Patents expiring, markets changing, consumer tastes shifting away, whatever the reason. They're actively fighting that decline by pumping resources into newer high-growth areas, strategically reshaping their whole business.
It's about staying relevant, finding new growth engines.
Precisely. It's really visible in industries like pharma or consumer goods, where product life cycles are key.
Yeah.
They're shouting about their pipelines, their new launches, to offset the old stuff fading.
ABBV is like the textbook case from these reports, isn't it? Humira, their huge drug, went off patent loss of exclusivity or LOE. Sales crashed, down over 50% in Q1.
50%. That's a massive hit for anyone. But, and this is the key point, their overall immunology portfolio still grew strongly, over 16%.
How'd they manage that?
Because their newer drugs, Skyrizi and Rinvoq, saw absolutely huge growth. Skyrizi up over 70%. Rinvoq over 57%. They're successfully shifting the market to these newer, protected products. Plus, neuroscience and oncology grew well too. Diversification works.
J&J had a similar story, right? Stelara hit LOE, sales dropped over 30%, plus some Medicare headwinds.
Yeah, big headwinds. But they still eked out overall operational sales growth, about 4.2%, and adjusted earnings growth. Again, strong performance from newer oncology drugs like Darzalex, successful recent launches, plus their other immunology drug, Tremfya, grew over 20%, and their medtech device business did well. It cushions the blow.
And Eli Lilly, they're all about that new growth, particularly obesity drugs.
Oh yeah. Mounjaro is gaining a lot of market share, driving most of the growth in its categories. They're super excited about their pipeline oral options, even more powerful drugs coming, aiming for that massive expanding obesity market. Making medicines more accessible is their angle. Novo Nordisk also mentioned Mounjaro's gains, by the way. And Roche highlighted their young portfolio, making up almost 60% of sales now, driving future growth, avoiding that patent cliff scenario.
It's not just pharma doing this reinvention. Philip Morris International, the cigarette giant.
Right. Total shipments were up a bit, but the real story was their smoke-free portfolio grew over 14%, e-vapor up 107%, oral stuff like ZYN up 27%, heated tobacco up 12%. Cigarette volumes might actually decline for the full year. It's crystal clear, smoke-free is their future growth, especially ZYN in the US.
A massive pivot. And SAP in software.
Same idea, different industry. Cloud revenue surging, up 27%. Traditional software license sales are slightly down. That's their deliberate shift to a subscription model, away from upfront licenses.
Yeah.
A fundamental change.
So what this means for you, the listener, is that these companies you know are making huge bets on new things. It affects what medications become available, what consumer products hit the shelves, the software options you have, as they pour R&D and marketing into these newer growth areas.
And trying to manage all these forces, the AI race, the cautious consumer, the geopolitical risks, the need to reinvent it, requires a really tricky internal balance. That leads us to our fifth and final theme.
Okay, the final piece of the puzzle.
Theme 5, balancing strategic investment and operational discipline.
Right. So in this, let's face it, volatile world, companies are chasing ambitious long-term goals. Big money into AI, R&D, new markets.
But at the exact same time, they're laser focused on cutting costs, being more efficient, optimizing what they already do, squeezing more out of the existing operations.
It's like funding the future by tightening the belt today.
Precisely. And it sometimes means tough choices, restructuring, selling off businesses. J&J was clear. Innovation investment is top priority, over $3 billion in R&D in Q1 alone. But they're also committed to shareholder returns' 63rd straight year of dividend increases. They even mentioned reversing a big legal reserve, saying it doesn't impact their ability to invest or manage the business, showing strength.
And ABBV, while planning that $10 billion U.S. investment for growth, is also focusing on cost efficiencies to handle potential tariff hits, doing both simultaneously.
Salesforce gave a great insight here. They talked about their huge innovation transformation, data cloud, AI layer happening alongside a huge financial transformation. That meant deliberately slowing down distribution growth in some places to boost margins and cash flow.
So the efficiency drive enabled the next strategic move.
That's exactly what they imply. Achieving that efficiency goal is why they now feel very comfortable going after a big acquisition like Informatica, the efficiency fund strategy.
Got it. What about Alibaba?
Similar story. Pursuing that user-first, AI-driven strategy, investing heavily in AI infrastructure, but they also delivered strong profit growth, adjusted EBITDA up 36%. How? Partly by optimizing their portfolio, selling off non-core assets for expected cash proceeds of $2.6 billion.
Using proceeds from divestments to fund new bets.
Right. And they're also investing aggressively in instant retail rapid delivery stuff, which is another strategic growth area for them, besides AI.
Nestle basically spelled this out, didn't they? Their strategy is about boosting cost savings and productivity.
Specifically so they can invest in brands, fix underperformers, innovate, even when consumers are cautious. The efficiency enables the investment.
And GE Aerospace in manufacturing, driving margins up significantly.
Yeah, impressive margin expansion, over 460 basis points, through service, mix, price, while tackling supply chains and controlling costs, and also investing heavily in R&D and new facilities, doubling their U.S. investment pace.
Abbott Labs, too, highlighting gross margin improvement as key to hitting profit growth targets.
Right, that operational efficiency focus side by side with investing $500 million in new U.S. manufacturing and R&D sites, it's the same pattern.
So, listener, what this means is companies are making these big, potentially game-changing bets on the future AI, new products, new markets, but they are not throwing money around blindly. They're scrutinizing every dollar.
Absolutely. And this balancing act, it can impact jobs, pricing, the stability and focus of the companies you rely on every day.
Okay, so let's recap these 5 themes we pulled directly from these Q1 reports. First, that intense AI infrastructure race hitting capacity limits.
Right. Second, the cautious and divided consumer, especially in developed markets.
Third, the very real business impacts of geopolitical friction and the drive for supply chain resilience.
Fourth, how established companies are actively reinventing themselves, shifting their portfolios towards new growth areas.
And finally, that constant balancing act, making huge strategic investments while demanding intense operational discipline and efficiency.
Those are the big narratives emerging straight from these major global companies in Q1 2025. They paint a really complex picture, don't they?
Definitely. Rapid tech change and strategic shifts happening against this backdrop of demand uncertainty and geopolitical risk. It's quite a dynamic mix.
And these reports, they're just snapshots in time, of course. Things evolve.
Exactly. Trends can accelerate or pivot.
For sure.
So, as we look ahead through 2025, here's a thought. What surprising interceptions or maybe even conflicts might pop up between, say, that breakneck speed of AI adoption we talked about and that backdrop of consumer caution and trade friction? How are companies going to juggle those potentially opposing forces?
That's a great question. How those forces interact will be fascinating to watch in the coming quarters, how they manage that tension.
Indeed. Well, thanks for joining us for this deep dive into the Q1 2025 earnings landscape. We hope pulling these threads together gave you a clearer, more connected view of the major forces shaping things straight from the source.
That was useful.